Welcome back, Dan. Another episode. Good to see you again. Today's episode, we're going to go into structures, what the main structures are, pros and cons of the structures, use cases, and some other tips and tricks around the structures. So let's dive straight into it. Summary of the main business structures. What have we got?
Absolutely. So usually the main structures we'll see is, especially for small business owners, would be first sole trader, sort of the most common, low barrier to entry, quite easy to start up. Then we'll go to a partnership, bit less common, has its benefits, obviously its pros and cons, which we'll go into. Then there's also trust, very common. There can be family trust, discretionary trust, unit trust, a few different options there. And then also a company. So that's one of the biggest ones we usually see. Lots of benefits using a company, and also a mix of structures. So you'll see quite often a mix of a family trust and a company, usually to help protect liability or protect the individual, protect the directors. Using a mix of the structures will help, I guess, lower some tax implications and a lot of benefits by utilizing the different structures together.
Yeah. Gives you a lot more flexibility and lots of benefits from the multiple structures coming together. So. So we'll start with the sole trader. Some of the basics. It's probably the easiest to get into when you start a business. For anyone that's not aware, when you're a sole trader, it just means that you're operating a business as yourself. So for me, it would be Andy. I'm just operating as my own legal entity as myself. The income that I earn, taxed at my marginal tax rate. So if I earn 45,000 or less, then I'm taxed at that tax bracket. If I earn 300,000, well, I'm taxed at the top marginal tax bracket. So there's not much you can do in terms of minimizing your tax when it comes to layering the income around. Some of the other pros and cons we've got.
It's simple to set up, as Andy said. You kind of just need to apply for an ABN with the ATO, and that's how a sole trader is set up. Obviously, you have to write in your description, depending on what you're doing. The costs are lower as well, much lower than a trust or a company, for example. And usually a good place to start if you've got a business idea. You need to declare that income, obviously, the income that you make or any profit. And usually sole traders are the best way to do that. But it also comes at some cons. So it's not as flexible with tax rates. Obviously, if you have a high profit, you'll be taxed at the highest marginal rate because all the income gets distributed to yourself. And because you're in a sole trader, you're also missing out on some other tax benefits, such as within a company, especially a base rate entity that has a flat 25% tax rate. You're kind of missing out on being able to distribute that profit to give you the best taxable outcome. There's also a bit of a risk protection for assets because, as Andy said, you're operating as a legal entity as yourself. It's not separate to yourself. So any assets that are owned by you, there is some risk involved there.
Yeah. And it's a good point, right? So the profit is taxed at your marginal tax rate, which can be as high as 45 cents plus Medicare. The lowest company tax rate being 25 cents. So it's a big difference in terms of tax. So, and the protection of the assets. So if you own your own home and you are in a high risk industry, well, then you're very exposed. But there is things that we can do to mitigate that. So I guess the best example of when to use a sole trader, starting out, or you just want to keep it simple, or you're more of a hobby or whatever. Probably the best time to do as a sole trader.
It's definitely a good starting point. It's a lot cheaper as well. You don't want to jump into setting up this huge structure just to start this business and realize it's not profitable, it won't make you any money. It's definitely a good way to start, and then if you find that your profit's just increasing significantly and you want a bit more flexibility, a bit more protection, then you can look at some other structures just to help protect yourself and also maximize the tax benefits.
Perfect. So the next one would be partnerships. A little bit more complex, but again, probably the second rung down in terms of the next level of structuring. Usually the income is split 50-50 or whatever the partnership agreement is, 40-60, whatever it happens to be. The partners can be individuals, companies, trusts, any combination of partners in it, super funds, for example. We'll just cover off on if it's individuals, and we can go into a bit more detail later.
Yeah.
But if it's individuals, how does that look in terms of a partnership of individuals?
Yeah. So with a partnership, there's going to be partnership, or the individuals will have an ownership within that partnership. So for example, a 50-50 split, could be 60-40, just sort of depends on how it's set up. It can be changed, but it's not as not too common that we see. But yeah, usually there'd be a 50-50 split, for example, or a 60-40. Any profit made in the partnership will be distributed at those percentages. So if, for example, the partnership makes $100,000 in profit, that will be split depending on the distributions. It doesn't get taxed within the partnership, so any profit again gets taxed at your marginal rate. So if you're getting taxed at the highest marginal rate, any profit will also be getting taxed at that highest marginal rate. Some pros within partnerships, usually the shared financial resources, so both partnership or the partners that are within that partnership can utilize their financial resources to help start up the business and go on that way. There's also a bit of a flexibility with distribution, because you can again update those distributions. A bit different to a sole trader, where any profit made within that sole trader has to go to yourself. It's also a bit easier to establish and at a lower setup cost compared to some other ones. But there's also some cons as well. So as we said, there's the shared financial resources. There's also the cons of the, I guess, joint liability. So you're both exposed to the same similar risk. It can be a bit more complex, especially if further down the line the business grows significantly. Maybe the partners might have a falling out. If things like that happen down the road, there can be some more issues, and especially if the partnership breaks down, a lot of issues that can happen with that. Partners may disagree on business decisions as well. It's a big one, I guess. If a partner owns, for example, 60% of the partnership, I guess they've got majority vote there as well. So
So I think it's good, like, to those points, to have a partnership agreement in place. See a lawyer to get your partnership agreement, so that you're clear on what the rules are in terms of each person's responsibility. A lot of the time we see in partnerships that there'll be a person in the partnership that is running and doing the day-to-day, and then the other one may be a finance, like, part of the business, so they're just putting in money to fund the business. In that case, you can do a partner salary to apportion it based on what's fair and reasonable for the work that the one operating is doing. So there is a bit of flexibility in terms of the profit distribution, but partnerships are, they do come with that higher risk, like you mentioned. So you've got that joint liability. So if we were in partnership and I go out and buy a boat and leverage it against the partnership, well, then you're in it with me, but you don't get the boat. So
yeah, exactly.
Just something to be aware of when looking at partnerships. So look, they're applicable for a multitude of things. A lot of families, like mum and dads, will go into partnership because it's related party. Where there's unrelated parties, it becomes more of a, okay, what is the reason we're going into a partnership? Why are we not doing a trust or a company? And there are many reasons that we would do a partnership, but just something you need to really look at carefully with the exposure to the liability and risks.
Yeah, absolutely.
But again, it is a lower cost structure to set up and maintain.
All right, so trust structures, another very common one that we see quite often. So what a trust structure is, it's sort of similar to a company, I guess, but any profit again is distributed. I guess similar to a partnership. I guess you get a mix of the two. It gets distributed to the beneficiaries of the trust. So for example, a family trust would have the parents, for example, and the kids in the trust, and any profit made in there can be distributed. There's also important tax laws to consider. You obviously can't distribute all your profit to your kids to be able to minimize all your tax, but there are some benefits with using a trust, that it's a bit easier to distribute and to also change those distributions as well. I guess depending on what the income will be for the individuals, you can do it ahead of time with the tax plan, for example, and that way figure out what distributions every beneficiary will be getting. It's also going to have an ABN. It'll be a separate legal entity. And there's also some pros and cons.
So, I mean, as you said, separate legal entity, if you've got a corporate trustee, gives you that level of separation from the underlying beneficiaries as well. Pros are that you do get that flexibility within reason. There's strict tax laws against distributing to minors, so keeping that in mind. However, the asset protection is a major one that we see people setting up these entities to hold assets and lease them to the trading company, for example. Like you said, you've got to come decide with a discretionary trust who you're going to distribute to before 30 June each year. That way you can do the trust minutes and distribute in accordance with that. However, it is a more complex structure, so you really want to understand that. And a lot of people come in and they don't actually understand it, but work with your accountant or your advisor and figure out if it's the right structure for you. Again, all profit must be distributed though. So if at the end of the year you've got a profit of 300,000 and you have to distribute it, well, it's got to go. You can't retain it in the trust. There is a bucket company arrangement that you can look at, which we'll have a chat about in a second, but generally all profit must be distributed. Losses do get carried forward if you meet certain requirements. Generally, if it's a family trust, they'll put in place what's called a family trust election, which essentially safeguards you against some of those rules that you need to pass. So you'll be able to carry forward your losses, franking credits can be passed on and things like that, but always get advice for your circumstances, obviously.
Exactly.
Unit trust, very similar, but the ownership is more fixed. So unit trust just means, so discretionary means the trust has discretion to who the income goes to. Unit trust is fixed based on your unit holdings. The perfect example is where you go and buy property with unrelated parties, you all put in money, you get your units, and then if someone down the track wants to sell their units, they just sell their units. You don't have to sell the underlying property. So you don't get a capital gain event for the trust. You don't have to transfer property and pay more stamp duty. So it's a great one for buying property. The disadvantage is that you've got the less flexibility, obviously, but it's usually you going into it with the purpose of, okay, we're buying a property or whatever it may be. But yeah, suitable for joint ventures and investment arrangements. It's usually the go-to. So.
Yeah, absolutely.
So when it comes to taking money out of the trust, if the distribution is what's declared as paid to you, but if you're pulling money out throughout the year, that is, seen as your drawings, you're taking your beneficiary amounts out. Similar to a partnership, you're taking drawings, you're pulling money out, and then whatever is declared as your taxable income is what you report to the ATO. Sole trader, anything you pull out it's yours anyway, so you're not pulling it out, essentially it's yours from the get-go, which is a bit different to companies, which we'll go into right now. So companies are a great entity for businesses because you retain the profits. There's a tax rate of 25% as long as you meet the base rate entity requirements and you are a small business. Base rate meaning that, as long as your income from investments or passive income isn't over 80%. Profits, then get retained, paid 25%. If you pay a dividend to the shareholders, they then get a credit for those franking credits. Pros and cons, what are we looking at there?
Yeah, absolutely. So, as you said, companies are great for trading entities, a lot of tax benefits, especially with that flat 25% tax rate. And some pros that you'll see, obviously, other than that 25% tax rate, is the ability to retain profits, as you said, which pretty much means, I guess, with a trust, any profits, or with a trust partnership or sole trader, any profits have to be distributed to yourself, depending on your margin rate. With a company, if a company makes a profit, they pay a flat 25% rate, depending if they meet those tests, which is the aggregate turnover under 50 million or passive income isn't over 80%. Example, interest or distributions and things like that. So with that flat company tax rate of 25%, the company will pay tax on those profits, and they're retained in the company. Then the company can pay those as dividends with franking credits, just so that those profits don't get double taxed when they get distributed to whoever the shareholders are. There's a few more strategies that you can use with companies, such as bucket companies and family trusts, and there's a few ways to utilize the different structures just to maximize the tax benefit, I guess. And then with companies, there's also some cons as well. As you said, there's some higher setup and compliance costs, and there's also some complex requirements that you need to do for compliance, regulations by the ATO, especially owner drawings. So as you said, with trusts, partnerships, sole traders, if you draw money from that bank account, you don't have to pay that back, for example. Obviously, it doesn't count as an expense for the company, but you can draw money out of the trust and sole trader business bank accounts. With a company, if you were to draw money out of the company, there are some stricter rules around that, because it pretty much just looks like the company is loaning you money, the individual, and you need to pay that back. Usually that's done in the form of dividends, but there's also an interest rate implication on that, which is usually quite high, much higher than any interest rate you'd get from any bank account if you had the money in your personal bank account. So there's definitely stricter compliance regulations, but there's also a bit more flexibility with companies as long as they're done right, compliance is met. There's definitely still some benefits with setting up a company. Any money that the individual loans to a company as well can be paid back, and that doesn't need to be declared as income just because the individual's already loaned that money to the company. But there's also some other issues that you need to be aware of when using a company as well.
Yeah, that's right. And, the Div 7A part of it, which is the ruling around loans from the company to the shareholders or directors or what have you, can be used as a tool to mitigate your tax over several years. But obviously you need to work with your accountant or advisor to come up with a plan to do that. So just something to be aware of when it comes to pulling money out and not having it taxed. So when it comes to paying yourself from the company, you've got the option of wages, dividends, directors' fees, all the Div 7A payments. But generally what you do is put yourself on a base salary, work out what you need to live off. Then based on the performance of the company, you can pay a dividend. Perfect thing to do each year is a tax plan. So anyone unfamiliar with a tax plan, it's just getting together with your accountant and working out how to optimize your tax position, as well as other things, but mainly to optimize your tax position. So it may be that you contribute to super, you pay a dividend, you get the deduction for that, you get the franking credits, and it puts you in a good position. But something that you need to look at in detail. So not something that we can provide advice on over this video, but we need to meet with the accountant and figure out what's best for you. But yeah, that's about it from a company perspective. So that's all the main structures that we see in small and medium businesses. There are a variety of others, but those are the main ones we do see. In terms of how they interrelate and coming up with more complex structures, so we mentioned that there is a thing called a bucket company. Generally used to reduce your overall tax because it'll be taxed at a 30% tax rate. So if you've got a trust that's earning a lot of money and you've got nowhere else to distribute that money, what they can do is set up a bucket company, distribute the money to the bucket company. It pays tax at 30%. It can then loan that money for various reasons under a complying loan agreement, and then be used to fund the business. So there's a lot that goes into that, but just one strategy that you can use to mitigate some tax.
Yeah, absolutely. And that 30% tax rate, it's a good way to utilize that, especially if the distributions from a trust are going to yourself and you're on the highest marginal rate, sitting at around 47%. If you distribute less to yourself and more to the bucket company, you're saving around 17% on the dollar, or 17 cents on the dollar there by distributing to the company, paying the tax there. The money's then sitting in the company. It's also already been taxed. So if you'd like to pay yourself dividends down the line, has franking credits imputed with the dividends, so you won't get double taxed, especially if there's years down the line where you're making less income, and you can utilize those dividends to being able to bring out those retained earnings from that bucket company to yourself.
Yeah, and it's a good tool because where you've got the company and you can retain the profits, if you know that you're going to have a bad year next year, or for whatever reason you may have lost a big contract, you might go on a holiday, family holiday for 6 months of the year, and you go, well, I am the one generating a lot of the income. I can just mitigate it by declaring it to the bucket company or whatever you need to do. Another good thing, another thing to be aware of with companies is PSI.
Yes.
So for anyone that's not aware, personal services income. So that's where you are deriving most of the income through your personal servicing or personal exertion. Implications of that, obviously quite severe. So
yeah, absolutely. So with personal services income, I guess when you're getting the income in the company, any profits on them are usually taxed at that 25% rate, like we've said. With personal services income, those profits actually have to be taxed at your marginal rate and have to be declared on your personal tax return or your individual tax return. And that obviously, I guess, the company will end up losing its value with utilizing those tax benefits, because now you're still getting taxed at the same marginal rate. So that's something to keep aware of, especially if you're wanting to set up a company but your income is only going to be PSI. It might not be worth it.
Yeah, so you may find that you go with just a sole trader because it makes more sense. But I know a lot of people do get set up in a company. They're subject to PSI, but it's because the people that they're trading with need it to be a company. So there are circumstances where it's still relevant, but just to be aware that you will not get that tax at 25% in the dollar. So. Another thing, holding company. So where you've got a family group and you have a holding company at the top, it has the profits paid from the trading company up to it. So the trading company pays dividends to the holding company pays it 30 cents in the dollar, and then it can loan it back down to the trading company for operations, or it can pay a dividend to the shareholder, which is usually the family trust, and then distribute it at its discretion. So another good one to mitigate risk in the trading company by paying out those retained profits, because if something happens in the trading entity and it's got $1 million of retained profits, well, there's $1 million on the table that can be subject to litigation. So just another structuring tool that you can use to mitigate some of the risks involved.
Yeah, absolutely. And with those structures that we mentioned, it's also good, especially if your situation might be a bit more complex, to use a mix of the structures. You don't just have to have the one company and that's it. You can use company, family trust, like you said, a bucket company or a holding company. I guess the more complex the situation is, whether you're planning on, depending on what your plans are as well for the business, if you're planning to franchise out, if you're planning to sell the business, there's a lot of different ways where you can structure it to be able to, I guess, mitigate the tax, mitigate risk, being able to set it up so that you're safe, your assets are safe, but you're also making the most out of the certain tax rates, certain benefits for each structure as well. Like you said, that holding company, it's great to mitigate that risk, and that's why structuring is so important, especially to get it right, especially why we've done it as an episode early on, just because it's something important to consider, especially when you're setting up a business.
Yeah, that's right. And so when it comes to having separate entities for separate purposes, a lot of people do set up asset holding companies that then lease those assets to the trading entity, who then pays the profits up to the holding company. So it can get quite complex, but the reasons behind that are the benefits that you get from that. So look, the best thing you can do is to find out what your purpose is in terms of running the business and how you want to build your wealth and get the money into a tax-friendly environment. Meet with your advisor, figure out a plan, and just implement that. That's how you're going to get the most cut through. You can read it all online, but really it's not going to be catered to your individual circumstances. So best thing you can do is see your advisor, get the structure set up that is going to suit you for the reasons that you're in business. So,
Exactly right.
but that's about it. We could go into a lot more detail, but we might bore you. So I think we might call it there. And then, if people have got questions, they can shoot the questions through and we can go into specifics. But
yeah, absolutely. Yeah, it's definitely a nice summary, I guess. Bit of information about each common structure that you'll see and most likely you'll come up with if you're looking at going down this route. But there's definitely a lot more information to go down, a lot more rules, a lot more regulations, but I guess it's a case-by-case basis, so most people wouldn't even come up against any of the stuff we might end up talking about, so it's probably not worth listening down into detail, but definitely something to keep in consideration when you're looking at setting up a structure.
Yeah, perfect. All right, see you on the next one.
Yeah, thank you very much.